This is chapter 7 about balance sheet in financial institutions and insurance operations. What is a balance sheet? And what are their characteristics? It is determined by accounting rules. You know that you must record all your operations under some kind of rules. These rules come from different sources. In some cases, they come from the accounting plan. If we are speaking about the accounting plan, it means that this is a plan that is dictated by the government. In other cases, you will find an accounting plan that comes from the Superintendencia de Mercado de Valores. And all the institutions that price it in the stock market must follow this accounting plan. And it is to do so in order that you can compare financial statements from different entities that comes from different economic sectors, and you can know which is better if you want to invest. In the other way, the Superintendencia de Mercado de Valores follows some rules that they are following in other stock markets. This means that you can compare the financial statements of Peruvian companies with the financial statements from other countries, and you can, by this, determine it is better to invest in this company in our country or in a similar company in another country, because their financial statements are comparable. We can say that it means that they are homogeneous. On the other side, we have the SBS accounting plan. And the SBS accounting plan is the accounting plan that we are following when we are a financial institution or an insurance company. And all these plans follow the GAAP, General Acceptance Accounting Principles. And these principles are followed by all of them in order to have an homogeneous criteria to record all our operations. And what is a balance sheet? It's a snapshot, a photo of a particular point in time. It's not an accumulated flow. If we are speaking about a cash flow or about income statement, we are speaking about a flow because it begins in one time and ended in another time. If we are speaking about a balance sheet has not a beginning, only show you which is the situation right now, today, at the moment that you are reading it. By this, when you read the financial statements, you will find that in the head, in the upper side, you can read at, for example, 31 of July, 31 of December. So it's a determined date. It's not a flow. And it shows how is the financial institution at this moment. What are the parts of the balance sheet? You will find some items that are the most important. Lending and deposits. You will see that in these two concepts are many other concepts, sub-concepts. Trading assets, those assets that you will buy and sell in a short time. Treasury and interbank assets. These are, treasury is cash in the most part of the cases, and interbank assets are those collectible receivables that we have and we can collect to other financial institutions. And finally, long-term assets. In these long-term assets, we can find fixed assets, fixed and variable securities, Tier 2 capital, and equity. We will see what is Tier 2 in some slides after this. But we can say that it's some kind of capital equity categorization. As we have seen, the balance sheet has some kind of components. If we are speaking about assets, they are cash, loans, financial instruments, and if we are speaking about financial instruments, they are long-term instruments, fixed assets, and off-balance sheet receivables. On the other side, in the side of liabilities, obligations, we have short-term liabilities, deposits, financial instruments, in this case, in the most part of the cases, short-term. In the most part of the cases, you will see that financial institutions receive funds or source their financial operations with short-term instruments, and they lend them in long-term. We could see long-dated debt. They receive funds from long-term and equity. And finally, like in this case of assets, we have off-balance sheet accounts. And in this case, we are speaking about liabilities. We have seen that in the case of liabilities, we are meaning that, for example, that they are, for example, letter of credit, letter of warranty, standby letter of credit, that are potential obligations. They are not right now obligations. They are potential obligations. It could be that if our client don't accomplish with something, to pay or to deliver something or to do something, then the beneficiary of this off-balance sheets accounts, a guarantee of letter, letter of warranty or letter of credit, they these potential beneficiaries of these instruments could ask us to pay them because our client has not accomplished. Then if they don't accomplish, we have the right to collect this amount to our clients. These are the off-balance sheet receivables. About financial institutions liquidity. The financial institutions liquidity management is the bank's ability to reconcile their cash. They have cash. They receive cash. And when they have cash, they must attend to the demand of credits that comes from its customers. And at the same time, with this cash, they must attend withdrawals. And they try not to sell their financial assets at substantial losses. Or if they can, they will try not to sell them because they want to obtain a profit from these financial assets. But if they must sell them in order to attend to their clients, they are trying to sell them without substantial losses. Here we have an example. Suppose that we have 100,000 soles in cash. We have trading securities and they are valued at 50,000 soles. In total, we have 150. And we have a demand. We have new credits demand, and they are amounted 70,000 soles. And we have deposits withdrawals that we must attend. They amounted 6,000 soles. In total, new credits and withdrawals totalized 130 soles. And we have 150. But from this 150, we have only 100 in cash. We don't have enough cash to attend all this demand. It means that we must sell trading securities. That we have the need to sell them. And we need to sell them at a price. If we need to sell them at a loss, it means that, for example, I will accept, for example, a 2% of loss if I know that I will gain 5% when I lend this money to my new credit clients. This is the way by which I will attend. With cash, I will attend withdrawals. I will maintain, for example, 14,000. And then I have a demand of new credits. These new credits, for example, will produce an income of 8%. And if I sell my trading securities at with a loss of 2%, I will maintain a gain of 6 points. If I can lend this amount, then I am falling in illiquidity. or I can say that my securities are illiquid. Bank assets are liquid to the extent that they can easily turn into cash without incurring a loan and a loss. I need to sell my financial instruments, and when I sell them, I will try not to lose money. And if I can do this, if I can sell these financial instruments without lose, then I can say they are liquid. But if I can say that they are illiquid if they will produce a loss, because I must look for a bad price in order to obtain the liquidity that I am trying to obtain. Bank liquidity. Much of the deposits have been replaced with instruments of greater stability over time. It means that I have some kind of operations, and I am trying to have, for example, to obtain deposits from my clients for longer term. Then, if they are from longer term, I am obtaining a more stable deposits. And when I obtain these deposits that the depositors maintain with me for a longer term, I have a greater control over the funding and liquidity. Suppose that I finance my operations with deposits that will stay with me only 2 days, 5 days, and I lend this money for 6 months. Then I have a problem. These deposits are not stable. I need to obtain and turn over these deposits every 2 days, every 5 days, because I need to maintain this credit, the financing of this credit. But if I could obtain funds, deposits for 180 days and lend them for the same term, then I have a better stability. But if I do so, if I obtain deposits for longer term, then I have a higher cost. The cost of uptake is higher. What is the cost of uptake? El costo de captar fondos. Cost of uptake. You have seen this picture in chapter 1. We have seen there that we have fixed assets. Fixed assets increase every period. Permanent current assets increase too, and we have temporal current assets, and they are increasing too. We can see that I finance fixed assets with long-term sources. If I obtain this kind of sources to finance fixed assets, I would have more stable deposits to finance my operations. And at the same time, if I have permanent current assets, it means that I will have assets that are currently, legally they are current assets, but if I turn over these assets at every time, as I find people who will replace those who are in maturity, I have a turnover, then I can consider that these funds are permanent, because I have right now 1 million, tomorrow my client will withdraw this million, but another client will bring another million, then I have a turnover. I have these funds as permanent because I see that always I have this amount in my cash. And with this permanent current assets, I could finance suppliers' credits that are short-term credits or long-term sources, both. Finally, with temporal current assets, I can only finance short-term operations, short-term loans, supplier credits, and so on. Here you can see an example. In this example, we have three zones or three situations. The first one, what we called many years ago. Many years ago, financial institutions trade to match terms, time. If they obtain funds for 30 days, in this case 200,000, they lend them for 30 days. They pay for this deposit 5%, and they lend them at 9. They obtain a difference, a margin of 4 points, 4 percentage points when they lend this money for 30 days. But when they obtain deposit for 90 days, they pay for this deposit 6.5, and they lend this deposit for 60 days, and they obtain 10.7 in this case. It's a mistake. It must be said 90. They obtain deposit for 90 and lend for 90. And they obtain deposit for 180 and lend them for 180. So the first case that we called many years ago is an example in which we can say how had operated the financial institutions many years ago. They matched exactly deposits with loans. And for them it was very easy because they have these funds exactly matched with the term. I obtain a deposit for 90 days, I lend them for 90 days. They are stable. It's a stable financial source. And with this kind of operations, they obtain in average 10.2% of income and 6.2% of cost. And the difference between both 4 percentage points was their financial margin. But when I operate in this way, it's like we say in marketing, it's a product or industrial point of view. What I have is what I sell. I don't prepare my products or service to the markets. I don't offer to the markets what the market needs. I offer to the market what I have, what I can produce, what I have obtained, not different. So some years ago, after this first situation, some financial institution has think, if I don't match exactly my deposits, I could satisfy my market better. Then, first line, you can see that they obtain again the same structure in deposits, 30, 90, and 100 days. And they obtain exactly the same amount, 200, 300, and 150. And they lend this money, but in a different way. If they see that they have a demand for 30 days loan for only 80,000 soles, they don't fight with their clients. They don't say, I have 200 and I will lend this 200 soles for 30 days. No. If I have demand for 30 days, I lend only what the demand asks me. In this case, 80,000. So you can see the first line in the middle example that I have 200,000 in deposits for 30 days and I only lend 80,000. I maintain with me 120. When we are speaking about 90 days deposits, I have uptake from my clients 300,000. And I can lend to my clients, but the demand is for 480,000. It's more. I have obtained funds for 90 days for only 300. I have a demand for 480. I don't have enough money for this. What will I do? I will lend them all this 300,000 that I have obtained, and I have 120,000 soles from 30 days deposits. I will lend this money at 60 days. Then I am running a higher risk because I don't match exactly the funds. I don't have stability. I'm financing a longer term credit with a shorter term deposits. But I will obtain 10.7. I am obtaining a higher interest rate, higher risk, higher income. And the deposit of 150,000 has of 150,000 soles. With this, I will attend with the demand of 90,000 soles, and I will charge 11%. But the demand is not enough. I have only a demand of 90,000, and I have a deposit for 150. So I have an excess of 60,000. With this excess of 180 days, I will supply this fund to the 60 days loans that then I have demand. So the demand of 60 days loans, I have attended it with 120,000 soles for 30 days deposits. I have attended with 300,000 soles for 90 days deposits, and I have attended with 60,000 soles from the 180 days deposit. So with 3/3, I am attended this demand. And what is the situation? The cost is the same. You can see that the average cost is 6.2. But right now, as I am attending the market in the way that they are needing, as I am satisfying the market, as I am adequate my services with the market needs, I am gaining 10.5. I am gaining more than in the previous situation. In the previous situation, I offer to the market what I have, what I produce, what I have obtained. 10.2% per year. In the second, I adequate my offer to the demand. I obtain 10.5%. And those banks who had begun with this kind of mismatch have obtained a higher interest rate, a higher margin. And as other banks have seen, they are gaining more, they have copied what they have done, what they have did. And nowadays, as all banks are doing the same, we have another problem. What is this kind of problem? First thing, I don't have any advantage because everyone is doing the same. And we are speaking about a service that is like a commodity. And it is like a commodity, I can't differentiate. I can't nearly not differentiate these services. It is possible to differentiate it, but it's not a matter of this course. But we can differentiate services. And in this case, if I try to attend my clients, I will obtain a higher margin. But if everyone do the same, the margin will slow and we won't obtain any advantage. Now the problem is, what can I do to recover a better margin, or what can I do to have a better cash management? Because the middle example determines that we have problems in my cash management as I am moving or locating funds from shorter term to longer term and from longer term to shorter term. This means that I am running higher risk, that I have more difficulties to operate. How can I solve this problem? And they have solved this problem reducing their margins, but increasing the alternative to the market. And when they increase the alternative to the market, they have changed many things. For example, in the two previous examples, they operate only in 30, 90, and 180 days. In this case, we are operating in 5 periods: 30, 60, 90, 180, and 360 days. And I have ample the loans too in these 5 periods. And in this case, as I have increased the terms, the times at which I am lending money, by this way I have increased a little my margin. But on the other way, as I have more competition, some of these interest rates has being reduced. Then we can see in this case that I have different deposits from different terms, and I lend this deposit to different other terms. For example, 30 days deposit, I have 75,000 soles, and I lend them for 30 days, but I have a demand of 80,000 for 30 days. I don't have enough money at the 30 days term to satisfy this demand. I need to use funds from other terms to satisfy them. In this case, 60 days deposit has reached 150 soles, and I have only a demand of 130. Then I can finance the difference, this 5,000 soles from the 30 days demand with 60 days deposit, and so on. You can see. And with this activity, I have increased my cash deposits to 6.7%, and I have reduced my interest income to 2.4%. At the end, because we are in a competitive market, we have reduced our margins. It's like every other economic sector. You can see that you can innovate, you can create new situations, you can obtain higher margins at the beginning, but in the time, margins will be reduced. What are liquid financial institutions assets? And they are related with the rights that have the financial institutions. Financial institutions have assets. It means that if I lend or invest these assets, I have the right, I could oblige to my clients to pay this amount at the end of the maturity. When we review the balance sheet, we can check that we can have a better explanation about every one of these items and understand better these institutions. So we will begin with this in a few minutes. Here we have funds. We have cash and banks and correspondents. We can see that we have interbank funds and net investments in which we have diminished provisions and some accurate incomes. What can we see here? Cash is not so important for banks. They don't have much cash. Why? Because cash don't produce incomes. They reduce cash a lot. And they have banks and correspondents amount. What is this? What they lend to other financial institutions. When they don't have a better alternative to invest their money, they lend this money to other financial institutions. The income is not so high, but it is better than to maintain them as a deposit or as cash. And when we are speaking about fondos interbancarios, it means that, or interbank funds, it means that we lend this money to other banks. In the case of banks and correspondents, we are lending this amount to other institutions to finance import and export operations. And if we are speaking about interbank funds, we are financing internal, domestic operations. And when we are speaking about net investment, net from provisions and from accrued incomes, we can see that the most part of the cases we have trade securities, and these are the most higher component in this item. These are short-term investments. And when we are speaking not from trading securities, we are speaking about securities investment. Securities investment are long-term investments, and you could find in this case bonds or shares. And when I buy bonds or shares, I can divide these two kinds of investments in temporary or permanent. If we are speaking about temporary, we are speaking about trading book. And if they are permanent, we can speak about banking book. And it depends on my decision of maintaining them only for trade, or if I want to maintain them for long term until its maturity, or if I want to maintain a relation of investment with the companies in which I have invested. If I maintain this investment under shares, it's because I want to maintain a control over this company, or I want to do many other kind of relations with this company, and by this I will exploit my position into this company with shares. And I have showed you this picture in chapter 1. In this case, you can see fixed income securities in the left side, and on the other side of this left side, the variable income securities. I have explained you this picture in chapter 2, in chapter 1. You can read it again because it can it will be useful in this chapter again. You can read them. You don't need more explanations because I have explained it previously. Loans. The most important assets of every institution. If you check financial institutions' statements in our country, you will see that multiple banks have loans, and this represents nearly the 75 to the 85% of their assets. Nearly all their assets are loans, different kind of loans, but they are loans. It means that they invest or they channelize their funds over this kind of operations. And they are the most profitable operations that they have. Perhaps the only exception could be some kind of investment that they could have too. The least profitable of all the loans that the financial institutions have is the mortgage, because it's the less risky operation. In the case of mortgage, I lend money to my client. My client will invest in this good an amount. In the most part of the cases, no less than 20 or 25% of the mortgage value. So I will finance only in the less favorable case. I will finance only the 75 to the 80% of the value. So I have a protection because the client is buying 20 to 25% of this mortgage. Second, when I take this mortgage as a guarantee, I will value it at the 80% of its value, nearly the same price that I have loaned. And in many cases, you will see that clients will invest in these mortgages the 40%, the 30%. It means that I am more protected. And if they don't pay, I will begin a judicial process, and I will take this mortgage at my name. The other operation that is nearly the same kind of operation of the mortgage is the leasing operation. In the leasing operation, you can see that the risk is lower because in the case of leasing, the financial institution is the owner of this entity, of this guarantee. Then it's easier to take it if my clients don't pay. Here you can see information about loans. This information is the accumulated data of all banks, only all banks. And you can see here that we have different kinds of operations. The first one and the most important of them is what we call in Spanish vigentes. outsourcing, no, se me fue el nombre, es out algo. Bueno, vigentes. It means that I have lent to this loans to my clients, and they are paying them. They are paying on time. They don't have delays in their payment. Then they are vigentes. And in this case, we have current accounts, credit cards, discounts, factoring, loans, financial leasing, mortgage for home. You could find some other kinds of mortgages, but in this case are for home. Trading, international trading, and some other kinds. But the most important of all of them, if you can see, are what we can call loans. They represent nearly the 40% of all the kinds of loans that financial institutions have offered to the market. And the second important is leasing, financial leasing, and the next is mortgages. If we add these three concepts, we can see that these three concepts represent nearly 55, 57, nearly 2/3 of all the credits that these financial institutions are offering to the market. This is something very important because it means that it is not necessary to analyze all other kinds of services because they have concentrated nearly more than the 2/3 of the credits in these kinds of operations. We have refinanced operations and restructured operations. What is the difference and what they are meaning? We have créditos vigentes. If financial institutions have offered these credits and their clients are paying them. If they are paying, they are vigentes. But if they have a delay, they will fall in refinance operations, refinanciated operations. And what means refinanciated operations? It means that this client can't pay under the conditions that we have agreed. We need to increase the term. If they must pay the credit in 6 months, we must increase it to 2 years, for example. And they have a cash flow that will produce the necessary funds to pay these funds. Then this is a refinanced credit. A refinanced credit is only some kind of credit by which I have increased the term. Not necessarily other things. You will see that in some cases they will offer more warranties, or the bank will look for more warranties and so on. But refinanciated credit is only a credit that has increased its term. But if we are speaking about restructured credit, it is bad. It is a worse situation. Why? Because in this case, we have seen that they not only need to increase the term, we need to increase some other conditions. It means that, for example, we need more warranties or better warranties. We need to restrict their operations. They will sign a contract that will restrict their maneuver. They couldn't lend, for example, their assets. They can't distribute dividends. We will restrict all the things. So a restructured credit is a worst case. In both cases, when we are speaking about refinanciated operations or restructured credit, it means that these are not normal credit clients. They are not. They are less than clients with potential problems. Okay, this is refinanciated and restructured credit. But what is the good news about this? That they are paying. That they have renegotiated their operations and they have the character, they have the idea to pay. On the other hand, or not on the other hand, we have the delayed credits, atrasados. And in the case of delayed credits, they are credits that our clients are not paying. We are trying to negotiate with them their payment and they don't pay. Or if they have a delayment and we are negotiating with them, we have not an agreement. Perhaps it's a tolerable delay, but we are seeing that they won't pay. These are delayed credits, and we can divide it into two kinds of credits. Those that has ended and they don't pay, but they are not in a juridical via. We are negotiating with them, and those that are in juridical via, and these are in a court. We are trying to obtain to recover these funds in this way. These are the most important items in this thing.